Hello everyone, this is John reporting for the Bottom Line Commodity Report. It is Tuesday, April 10th. First off, today, in the bond market, the bond monthly pivot resistance 141.23, and you can see that right there on the line. We had a high today, 141.27. Good, bad, or indifferent. First thing, let me go and bring this into a 15-minute chart. You can see the trade action. And I don't know how many trades in a row it's been, but we got on this initial surge to the upside. If you look at the data bars up in here, as I scroll over, you'll see we had an initial high of 19. On that rally high, within that 15-minute bar, we got filled, forming that shooting star. I got news for you. The bond market, I've only traded them for approximately 27 years or so, and I can tell you this: bonds do not give free gifts. Generally, we sold the exact high tick. The market did break down, and just like with the euro, the currency the other day, or just like cattle the other time, or just like the British pound. I mean, there's been so many trades that my analysis has just been right on. I'm going to have to go back to the drawing board, but I can tell you this: when it's I wouldn't mind if the market didn't fill me at 19 and then came back and then traded through it, and then finally we deserve to get filled because the market traded through us. That would be one thing. But when you're looking at a stock market correction that's in dive mode, people flock to bonds, and then gold starts to catch a bid. Gold's rallying, in other words, and we get short on the high tick. So it didn't trade through us. 19 was the high. We sold, and everyone got filled. I know that. The Bottom Line newsletter traders, everyone, auto traded with letter of direction through brokerage accounts. Everyone got filled. When you get filled on the high tick, it's generally not the high tick. So that's why I gave the order get out, because I didn't know in a market environment where it's in DEFCON 3, where the market's crashing, the stock market crashes, if people just flock into bonds. The bonds could rally 2-3 point handles. And here you are sitting there with a short position, and you had the clue that you could have gotten out. And that's why I gave the order, get out of this thing. We needed the market to trade through us to 14. That's why I said get out at 15. You make 4 ticks, it's $125. My bad on that one. I thought it'd be a great trade to sell it at resistance. We think the S&Ps might be peaking out, but as you can see, here we are trading at 141.15, right where we got out of the trade. So there is still no harm, no foul on a daily basis. Let's take a look at end of day. End of day. We have this failed doji top. That kind of concerns me. So maybe we can go a little bit higher. So I'm not going to give this another whack or stab at it until we get a definitive sell signal. Let's call it, say it like that, more professional terms, excuse me. So that's the trade today, and I think it was good common sense. So let's take a look at another trade I talked about in the trading room today, and this is in the Japanese yen. Now, the Japanese yen was also at the time, or just prior to that, the Japanese yen was trading right near its monthly resistance. And one of the things that I stated is that as goes the yen, so do bonds. So when yen typically has a correlation with bond prices, futures that is. So when the yen futures rally, bond futures rally. If you read the Bottom Line newsletter, we were talking about looking at getting long the yen. So why would I be selling the bonds? Because look where the yen closed for the month, 120.79, and 120.79 is at the end of the month was down here. Wait a minute, and 120. Here we go, down right in here. So the market closed here. I was hoping to be a buyer near monthly support. And looking at the bearish, because Mario was giving us a bearish outlook, we were looking at buying near around 116. So I thought that would be a great value play as an oversold market condition, considering the fact that last month we had a high of 124.21. I mean, look where this market's gone. So we had a high way up here at 131. Last month we had a 124 high. If we had any further declines into this 116 area somewhere down in here, I mean, that would be just, I believe, a great value purchase, and we'd see at least a night rally like this. So anyway, that's what I was looking to buy the yen. All right, I'm not looking to buy the yen at 124, 123.70. But now that the market's rallied up in here, we'd say to ourselves, okay, John, thanks for that explanation. Now I understand why you were looking at buying the yen. But today, when we were up near this pivot resistance, we hit the pivot resistance at 7:30 this morning. One test, the market pulled back. Second test, the market went right through it. So if you sell the yen near resistance and wait for a sell signal, and then the bonds catch up and they rally, and you sell the yen and you're selling the bonds, you're virtually committing trading capital to twice the position. You're trading two correlated markets in the same position. So you might as well. So that's one of the things that you got to be careful as a trader, and that's one of the things that I am careful and cognizant of when we do the newsletters. What markets correlate with each other? Because I don't want to get into two of the same trade. I don't mind buying the yen, 400 points lower than say its monthly close. But I'm not, getting into a short yen when I'm looking at selling the bonds. So that's the explanation there. And I know if you were in the trading room today and you heard me say, hey, let's not, don't be a hero, even though we are at the resistance, I'm going to wait to see what it looks like because we're looking to sell the bonds. And at the time, the bonds were just at, like 141. 0406 range, so they hadn't even rallied up yet. So the yen moved up, and then the bonds followed suit. So I didn't mind the bond trade initially because of the fact that with the stock market, with the tax time, this little sell-off, and that's now what I'm going to follow in next is with the S&Ps. As you notice here, you read the newsletter, we wanted to be a seller if the market, I didn't think we were ever going to get up here, but I was looking at a short somewhere around 36 based off the newsletter. Where the month ended, now keep this in mind, if we go over here and you say, okay, take a look at this, where the month ended is 1436 look probable. You take out this high, you get up in that zone, and sure, you look for a sell up there just under 1440, monthly resistance 1438. And that looked, with the trend is up, that looked very possible, high probability we're going to see that. You had this little higher high close in here from the prior two bars, little breakout. So yeah, easily we could have seen that. But as history shows us, it did not happen. We generated a daily sell signal. We had the month of unemployment. Everything was just kind of started to cave down. So looking at the newsletter trades, we had the right directional attitude and idea to sell rallies in the S&Ps. It didn't come to fruition. We had all the right reasons: seasonal trend, unbalanced volume, a break in the advanced decline. Other indices were showing us bearish divergence with advanced decline. So we've given a lot of trade through planning and scanning and all our weekly work that we do in the trading room. Hopefully that at least giving you an idea. Let's not get aggressively long up here. I don't think anyone was looking at that. In fact, in the trading room, we did made a recommendation several weeks ago for credit call spreads, where you sell a closer to the money call, you buy a deeper out of the call for risk, defined risk parameters. So it's credit call spread. So we had a credit call spread. They're not going to get you rich, but it's a high probability that you'll collect premium. Of course, we did just that. And that was a trade that we came up together in the trading room several weeks ago. It was in the spiders too. It wasn't even in the futures, so it wasn't even newsletter related, so to speak. But it was the trade idea that we were building. We tried to do one in the futures. There just wasn't enough premium with the E-mini S&Ps, and so that's one of the things. So the question begs now, where do we go from here? And I think that you get this pre-tax selling, and that's what we had up in here. And today was just follow through. Those who wanted to sell was up here. Those who need to sell are down here. In other words, those who wanted to take a profit were up in here, and those who need to sell because they were in margin call were probably selling today, and that got us down in an accelerated decline down at this 1350. So is this the end-all rally for the end of the year? Is the market topped out permanently? As you can see, we had a doji several weeks ago. This week, if we close below the lows here, which is 1380, we will form an official low close doji. This PPS using Thinkorswim is flashing an orange sell signal or bearish momentum. So if we close below these lows in here, we will get a bona fide sell signal in the market on a weekly basis. We haven't had one of those in a long time. So that means Friday is going to be an important day to watch. I believe that we're coming into the sell and may go away area of time of year. We have earnings coming up. I think with Google on Thursday, Wells Fargo, just to name the two of this week that are probably the most closely watched, will be fairly important, obviously. And my feeling is this. I think that we've just gone too far too fast to the downside. We'll get a pop. We'll see how we respect, if we do at all, this area. Now we got to see if we get back above, and the key for me would be 1370. 1370 was the initial low. It was this old area of resistance. It acted as support. It's blown through it. It should now act as resistance. So market rallied back up in here. You watch 1370. That'll be a very important number. And 1370 is also, if you look at the yellow, the moving average number, and it's, as you can see, right against these two lows. So if the market goes up here, tries to rally, and fails, does not close back above it, that would be, closing back above it would be rejection, and equal and opposite, and we won't know that till tomorrow. But if we travel up here and it comes back down, then we're still in a bearish mode. We're going to take a look at some of our market internals. Today's not one day does not give you enough data. We want to watch this for the next several days, but this is not, repeat, I'm not getting long the market against that low, but I am going to watch to see how the market trades, and if it does meet resistance between 1370 and let's call it 1374. So once again, 1370 to 1374, and let's see if we can find that, somewhere, as you can see right up in here. Draw the line in the sand. There's 1374 acting just against those lows. 73 and 3/4, 74, 74 and a half, 73, 73 and a half. So right in here between 70 and 74 should be a big line in the sand of resistance. Gets up there, first test of resistance, sell them as a day trader. That's what I'll be looking at. Okay? Next. All right, it does pain me, considering the fact that we called a decline in cattle back here. We went short, we made money, we got short, they stopped us out, we put our pants back on, we got back short, and we caught a little bit of profit on that trade. We got out near monthly support. We made some money. There was just no chance in the world's eyes that I would be, and I don't think anyone else has called this type of decline in the cattle market. And it's not just cattle. I'm going to show you a few other markets too, by the way. But we have traded it successfully a couple times along the way, based on experience telling me the way the cattle market, the characteristics, when it is a low, we generally see spike, not shaven bottom lows. See, that's a spike, like a hammer formation. Those spike lows, you see the tails or wicks or shadows, as I prefer to call them. You see those spike lows. That's kind of the characteristic of what puts the lows in for the market. We went long this market. For one lot traders, you take a nice profit. For two lot traders, we got out yesterday. Good timing. I didn't trust the market. I thought we should have opened higher. We had a chance to get out. And I wasn't sure if we were going to get down to the original newsletter, because we've already been in this trade once now. I don't mind the first time. The second time, I like to be a little cautious, and I wasn't sure we were, if 114.20 with the world in liquidation mode. You get margin calls in a hedge fund, and they go, "Oh, you're long cattle? Get out of that. Oh, you're long soybeans? Get out of that. Oh, you're long wheat? Get out of that." Boom, boom, boom. It's like a shopping list. They just keep hitting the exit button until the fund becomes flat. If they run into a margin or a debit problem, for example. And it does happen to funds. They get caught on the wrong side of the market. So if they're in the wrong side of a market somewhere, they got to liquidate to come back with a cash, because they certainly aren't calling their customers for more money. Though the moral of the story is, where's the low in the cattle? Is it 114? I don't have a buy signal. I don't mind trading it against these lows in here, but with the overall stock market, I want to see some type of stabilization and before this wash and rinse is done in the overall market. So let's take a look at some markets that have had wash and rinse. Cocoa. And sugar, we tried to get short sugar. We wanted to sell sugar. In fact, we actually didn't come too far away from selling the other day, so I just thought I'd let you know that those orders were not far off. But sugar's been in a liquidation mode. Wait till you see this one. Coffee. Coffee, look at that trend. You want to talk about liquidation mode. Is it coffee? Take this one, for example, orange juice. Remember orange juice, the big freeze? Remember that big news? Everyone they've lost sight of that in the media, haven't they? This big news about that big frost or disease, that are they going to halt imports to the United States from Brazil for orange juice? Seems there's a lot of orange juice. It's frozen. They can store it. There's lots of supply. So in any event, orange juice coming in 138 might monthly pivot support. Now that might be, believe it or not, a trade there. But what I'm showing you is a lot of commodities are starting to deflate in value. We've seen cattle. You've seen it in here's one. Of course, you're going to love this. Gold. Isn't the price of gold? Hasn't it been deflated or liquidated? Now you've got crude oil. Here's another commodity. I mean, we started to see that deflation come in, or deflating of commodity prices. How about this one? Natural gas. My God, that's been deflated forever. Then now let's take a look at our cash crop, corn. We just had a USDA crop production report, and it was fairly bullish. Low close doji. Rally didn't last very long. I was looking to sell and want to sell. In fact, we've got a recommendation in soybeans, even though I'm bullish longer term. In soybeans, just a little too excessive in valuation. If we got soybeans up to around that 490 area, and we wanted to take a look at selling the July soybeans at 489. So if you take a look at this market, in July beans, we got up just around to a high of 53. We want to sell closer to the pivot resistance because you got a couple, a doji from Monday. It didn't make a low close doji, but we'll be looking at maybe a short position in soybeans because it's probably one of the very few commodities that has not been in liquidation mode yet. So take a look at this. Wheat. Liquidation mode. It's down. So there's so many commodities here that are in a liquidation mode. I wonder if funds are just getting out of the markets and raising capital all entirely. So you've got a problem in equities, you've got commodities that are going down, so money has to go somewhere. Or is this liquidation a reflection of a slower economy on a global scale? We're going to monitor this. It's a good question. It's not just one commodity that went down today. Look at the price, pace of price change, and the percentage of price decline on a lot of the commodities on the board. I guess an easy way to do that, if it is the CRB, that's not it. Let's see if they have CRB. Yes, here it is. All right, so take a look at the Commodity Research Bureau. And I don't think they have the data, so that might be a problem. Anyway, the CRB index is definitely significantly lower right now, and that's so it doesn't exist. So there's at least the best I can get that you can see the direction. The CRB index is down significantly in the marketplace, and that, my friends, I think is. I'm a little concerned with that longer term, because is this deflation, is it good for the overall inflationary figures, or is it based on a lack of demand? Anyway, there's the present question. We got support in the CRB at 296, so we are coming close. We want to take a look at some of these commodities. And with that said, that runs out of time for us tonight. I'm still looking for some opportunities out there for us, but good risk parameter opportunities, and I am cognizant, aware of being in two of the markets that correlate the same direction, so we don't take a double up type of a position, as is an example with the yen and the bonds. But I'm working hard over here to try to make the best trades that we can get executed in, and some good strategies for us, so we can all see positive developments and make money for the year. Hope the information found you well, and we'll talk to you as soon as we have the next opportunity. Thank you, everyone.